Good morning, everyone, and welcome to our DATIQ weekly market update. I'm thrilled to be back. This is our show for April 23rd, 2024. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak this morning, who's our Principal Industry Analyst, and it's just the two of us this morning, Dean.
It is. Good to have you back after a couple of busy weeks of travel.
Yeah, it's been crazy, right? We had TIA, we had an executive conference last week in Denver. Conference season is in full swing, as I'm sure you were at Matt's. Lots going on. You'd never know from TIA that we were in the midst of the bloodiest bloodbath and the bloodiest history of bloodbaths ever.
Yeah.
There were 1,800 of our closest friends down in Phoenix.
Wow.
Golfing, drinking, smoking cigars as if the Titanic wasn't itself sinking.
Maybe they're getting in practice for when the market turns.
It's amazing, right? The word that I've used, you may know this, Dean, and so do our viewers. I latch on to words at times. And right now, my word is it's just resilient, how resilient the market is. It's amazing when you go to TIA, or I'm sure you see it at Matt's, or you go to ATA, or any of the big conferences. There's this population of folks that stay the same. They're there, right? You know, they've had kids, they've retired, they've moved, they've done all these different things, they've got new jobs, and then there's all the new faces too. And it's TIA is, I think, real emblematic of that because it's a lot of newer faces, but you really get to catch up with longtime friends and colleagues that you don't see every so often.
Yeah, I saw it at Matt's. It's like every year you go to Matt's, you see the same crew of people that are in the trucking industry, like the stalwarts of the industry who've been there for a long time. It's like you would swear that it's one of the most profitable, successful industries going around, watching some of these folks. And of course, it's a bit like a lot of parts of our industry. It's only on the margins where there's a lot of volatility, where people are coming and going. But for the most part, there's a lot of consistency in the trucking industry in particular.
Yeah, I mean, again, I think no one's going to argue that this is a pretty severe downturn at this point, right? But still, between 35 and 40,000 interstate motor carrier numbers have net attrited, and there's still 300 and some thousand left. So 10%, it's not the human toll of that. That is small American businesses that have went out of business. So we're not going to minimize that, but still 90% is still fully intact.
Absolutely.
And again, putting measures in place to get through so that they can get to the upcycle. So with that, let's get to our key points of the week and our market update. Hopefully we can shed a little light on what's going on out there. And walk you through what we're seeing. I think from a spot rate perspective, it's really interesting. We're putting some distance between 19, which is a really great reference year in these slow periods, but that's just purely because 19 was actually declining into this market. We're holding steady on a year-over-year basis to 2023 from a percentage point difference. I think that Dean can correct me if I'm wrong when he jumps back on, but I think it's about 8%, maybe pushing 9%, depending on what particular time period you're looking at. But about 25 days or so from now is when you would have seen 2023 kick up, largely due to road check and just some seasonal shipping activity. That'll be something crucial for us to watch over the next month or so. So by mid-May, if we're not seeing some blip there corresponding to what we saw in 23, I think that's going to ratchet up the worry meter. Active contract rates in the routing guide mostly flat, while replacement rates remain negative. But they're approaching parity. This is a really good sign. As capacity rebalances, as contracts rebalance, that indicates that we're moving into the next phase of the cycle. Michigan State's truckload ton-mile index for February 24 jumped 1.5% month over month, but remains down roughly 2% year over year. Again, let's just focus on this, right? We're not talking about 20%, 25%, 200%, right? Like these are small changes, but let's keep in mind small changes when you're looking at macro indicators have big impacts. Inflation came out at 3%. Everyone lost their minds, right? So let's just keep that in mind. Housing starts plunge in March. That's interest rate. I'm building a hunting camp in the woods of central Pennsylvania. And believe me, I'm tracking these interest rates, and they are less than bueno. March new truck orders tanked down 19% year over year and 37% month over month. I think you're seeing a lot of fleets catch up on their re-aging of the fleet and interest rates. Again, no bueno. Turn it over to Dean, go through our market update.
Yeah, thanks, Ken. We'll have to come back at the end of the show and talk about the size of that hunting camp. If interest rates are a factor. So let's start off with the load to truck ratio today in dry van. Load post volumes lost a little bit of ground last week, almost the exact same week over week change as last year. Interesting data point, 11% down last week. Equipment posts up slightly. Load to truck ratio sitting at about 3.44. In the refrigerated market, they also lost some ground last week. Reefer volumes down about 8%. Also exactly the same week-over-week changes last year in the reefer market. Load-to-truck ratio end of the week at about 4.64. And in flatbed, load post volumes fell for the fourth week. Again, not surprising. We was kind of getting to the end of that seasonal surge we see during the spring replenishment season. Volumes are about 4% lower than last year, sitting identical to 2019. Last week's load to truck ratio, 18.94, down slightly from the week prior. A few markets we're looking at this week, starting off with the top 5 spot markets: California, Texas, Illinois, Georgia, and New Jersey. Average line haul rates were flat last week. They averaged $1.70 per mile, also identical to this time last year in the top 5 states. Los Angeles, it's a market that benefits a lot from the current surge in Asian imports. The Los Angeles market saw 4% higher volume of loads moved last week. Again, a lot of the volume we see coming out of the Los Angeles market is directly connected to the rise and fall of Asian import volumes. The volumes of outbound loads are about 7% higher than last year. Despite the higher demand, though, line haul rates remained unchanged at $1.65, excluding fuel, for outbound loads. One of the lanes I watch a lot in terms of how we compete with intermodal is the 2,000-mile haul east to Chicago. About 30% of intermodal moves move on that single lane. Truckload carriers compete pretty heavily with the big IMCs. Truckers were paid an average of $1.50 per mile last week. That's 33 cents a mile higher than last year and 23 cents a mile higher than last month. Load volumes are increasing there fairly substantially. Since the end of 2021, as a point of reference on that lane, when demand for imported goods peaked during the pandemic, the volume of loads moved on that lane between Los Angeles and Chicago has halved, and line haul rates have dropped 57%, or almost $2 a mile. So they've dropped $2 a mile since the end of 2021 on that one lane. A lot of lanes look a lot like that when you look at the line chart of graphs over 5 years. In the refrigerated market, according to the USDA, capacity is tightening in Florida. They had a shortage of trucks last week. Not surprising, ahead of Mother's Day. We're starting to get into that period where a lot of volume comes into Miami from South America for carnations and roses. Volumes also up in Nogales, Arizona. Capacity was tight. Both markets reported a slight shortage of trucks, particularly for loads from the border to Chicago and Boston and New York. In Florida, outbound average state rates jumped 12 cents a mile, averaging $1.53, about 7 cents a mile lower than where they were in 2019. There is some data that suggests that the Florida produce season has peaked a little bit earlier this year. We'll have to wait for some more data to come in the next couple of weeks to confirm that. One of the big lanes we watched, Lakeland to Boston, carriers were paid an average of $1.77 per mile last week. That's the highest since last July. But also 22 cents a mile lower than where we were last year when volumes were much higher. Hunts Point, New York, out of Lakeland, rates are about 30 cents a mile higher than the March average, averaging $2.01 per mile, also the highest since last July. Having a look at the south border market of McAllen, where about 40% of Mexican produce crosses into the US. Volumes are up 8% week over week, almost the same as where they were this time last year. The Mexican produce season usually peaks in mid-May. Also, some interesting data points there suggesting we may have peaked a bit earlier also. McAllen to Dallas, carriers were paid an average of $2.59. That's down 22 cents a mile week over week. It had been increasing for the last 8 months. There's also been a big shortage of water in the Rio Grande Valley, where volumes are about half of what they were last year. So some of those border markets are producing a lot less produce than we would normally see as we get towards the end of April. In flatbed, although the total number of oil and gas drilling rigs has been flat since the start of the year, according to Baker Hughes, rig counts are up about 2% in the West Texas Permian Basin, where about half of oil and gas rigs are located. Supplying this region with drill pipe and casing is primarily the Houston market. It's a large manufacturer in Baytown. Loads moved out of that market with up 14% week over week. Outbound line haul rates in Houston up 7 cents a mile in the last month. On the number one lane west to Lubbock in the Permian Basin, where a lot of drill pipe and casing move, flatbed carriers were paid an average of $2.13 last week. The number two lane out of Houston is El Paso. Line haul rates were flat, averaging $2.39. a mile on a 13% higher volume of loads moved. So Texas is still a really good flatbed market. And we're starting to see a little bit of action on that West Texas lane again out into the Permian. Wrapping up our market update with a year-over-year look at spot rates, dry van rates decreased almost a penny per mile, kind of flat to down slightly, as Ken said at the top of the show. I've been moving in that direction for the second week, averaging $1.56 a mile last week, about 5 cents a mile lower than last year, but 4 cents a mile higher than 2019. Similar movement in refrigerated spot rates, down for the second week, down slightly, wouldn't say significantly, averaging $1.85, sitting about 7 cents a mile lower and 2 cents a mile higher than 18. So down about 7 cents a mile lower than last year, 2 cents up on 2019. And lastly, in flatbed line haul rates remain primarily flat to down slightly for the second week, averaging $2.02, about 12 cents a mile lower than last year and 2 cents a mile higher than 2019. So that's it for this week's market update. Remember, if you want to find out more about what's happening in freight and get a copy of the commentary from today and some of the charts, a long-form version of the report will be published this evening at dat.com/market update. Back to you, Ken, for the short-term forecasts.
Thank you, Dean. So what we're looking at this week, I've been gone for 2 weeks, as Dean said, so quite a different story. The models are starting to pick up on that seasonality that should be coming in. So we're going to start with spot, dry van, as we always do. The blue line's history. We got 4 models. Red is short-term, green is ratecast. That's what's in all of our products. Then we have gray and yellow, which are intermediate models that kind of blend the two, but not exactly. And what you're seeing is that basically what we talked about to start the show. We should start to see seasonality layer in here. I think the red model is wildly optimistic. I think ratecast, which has effectively another couple of weeks of bumping along the bottom here before starting to move up seasonally, would be the one that I would place my wager on if I had to predict how the next 3 or 4 weeks would play out. Let's go to reefer. Very similar story. I think these models are predicting an alignment over the next 2 weeks of upward swing. We're all waiting for that. I was talking to some produce shippers and a couple produce carriers as well. Just the lack of seasonality in the market right now has been rather remarkable. I think if you listen to everything Dean just said and what he's been writing about, that shouldn't come as a surprise to you. But it's still, if you've been around 8, 10, 12, 20 years, it's just not normal, right? That we'd see rates staying this flat to down for refrigerated heading this far into the year. And then lastly, moving on to flatbed, which I think is a surprise. I've seen a lot of chatter that flatbed, especially in the trenches, is remaining or actually gaining some steam. I think that's good. This is something where if we do see, to Dean's point about the hunting camp, logs are coming off every single day as interest rates climb. This is something where if we start to see, the good indicator I would track there is the builder subsidized interest rates. And usually, right, if that's below 5, you start to see a big spur in activity. If it's above 5, you start to see a pretty rapid decrease. And that's a little bit different than things you'd see on bank rate. But anyway, I think if we start to see that meaningful decline in interest rate, this is something you could see the lid blow off and have another really, really good year. But if you couple that too, friend of the show, last name Jalbert. I think his first name is Dustin or Justin. He's a great follow on Twitter. You wouldn't think a lumber analyst would be a great follow on Twitter, but the way he writes and what he tracks, we're seeing a rather substantial collapse in lumber prices, which again, maybe add a few logs onto that hunting camp. We'll see how it all nets out. But building materials and lumber are becoming much more affordable. So that's our short-term outlook. We'll bring Dean back for our question of the week, which I don't know if either of us, we had our guest cancel. So this might be Dean and I staring at each other because I don't know anything about government contracting.
Yeah. I think we probably skipped that. I think Ken, unless our guest jumps on, but interesting, some data points came out on single family housing starts last week. They were down about 15% in March. But I did look at some data. They're up fairly substantially though, compared to this time last year, but there's certainly a lot of pessimism in the market. Building permits, which are usually a good indicator of future demand, they fell by about 4% last month. A lot of builder sentiment, it's not as good as it has been. Sentiment was flat. If you look at the National Association of Home Builders, Wells Fargo Housing Market Index, that's a mouthful, the HMI, was flat in April as mortgage rates remained close to 7%. A lot of buyers are frustrated, sitting on the fence, waiting for interest rates to fall. It'll be interesting to see how this plays out, whether people start moving and selling homes despite the high interest rates. The NHB says there's a lot of demand for potential growth, but housing volumes are sort of much higher than they were last year and higher than they were compared to 2018 and 2019. It just doesn't feel that way in the flatbed market, though.
Yeah, I think it's tough, right? I mean, the housing sector is one of the most impacted by, the someone on LinkedIn posted, I have no idea where they got it and I lost track of it, a remodeling and construction index. And I think that's, really getting hammered right now because home equity lines of credit, when I refinanced, not to brag, I refinanced my house at 2.1% 5 or so years ago. And they threw in a home equity line of credit that I had no intent on ever using, but that was free, right? So why not take some extra leverage? It actually improves your credit score. Why not do it? And when I opened it, I think the interest rate was 0.8% on a variable basis. And I still get the statements. They won't do digital billing. So I still get the statements once a month and I just check it from time to time. It's like at 8.8% right now, 8.7%. So you go from essentially free, and we all know that people use home equity lines to buy cars, which you should never do. But some people do it. They use home equity lines for all kinds of reasons. And I think at 8%, 9%, whatever rate you're getting, it's just not worth it. It's that lumber's going to sit on the shelves,
Ken, I went back and looked at some numbers just while you've been chatting. We had single-family homes I watch pretty closely because they're the most freight-intensive of new residential construction. So last month at 1.02 million single-family homes started in the month. That translated into, these are rough back of the envelope math, but it translates into about 156,000 more truckloads than March of last year. When you think about an average of, say, 3 flatbed loads per single family home and 1 dry van towards the end of the building stage, compared to 2018, right, which was a really good year. Last month, we hauled 147,000 more flatbed loads and almost 200,000 more flatbed loads compared to 2019 in March. So even though things feel like it's not a strong flatbed market, we're still hauling a lot more freight as it pertains to single family homes. I suspect the bigger factor putting a lid on things is the ongoing excess of capacity that is leaking out of the sector ever so slowly.
I think that's right. And there's far less contract freight as a percentage in flatbed as well, right, especially on the legal load side.
Yep.
So I think you have less of that dynamic to really contend with. So I think it's kind of, in a lot of ways, flatbed's a more pure expression of spot because there's not as much private and dedicated and contract as a percent.
Yeah.
And the private and dedicated is truly non-fungible. Like if you think about private flatbed, what does that mean? I mean, that could be flatboard or gypsum board producers that have their own fleets and whatnot. And it's not really fungible like a little Walmart driver that's going to go potentially, move, buy their own truck, lease on with someone. So I don't think that's as absolute as I just made it seem. But at the end of the day, I think flatbed's doing better for a lot of different reasons. Fundamentally too, I think it's like a less attractive option as a driver, right? Getting out there. And all of us who have been on the road, whether you're paying attention or not, or I'm sure seen a flatbed driver trying to secure their tarps and check their straps in a blazing snowstorm, pouring rain, heat, covered in mud. It's a different experience than especially like live load, unload, drive in, where you might not even have to get out of the truck to get your paperwork signed, use the restroom. Yeah,
and you've got to have much more specialized equipment too, so that kind of narrows the field down fairly substantially, and you ended up with a much better rate per mile the more specialized the load is. So that sort of adds to that mix also.
I think that's right. Yeah.
Yeah.
But I mean, as we sit here, right, like it's, I think it's a tough market all around with, flatbed being the one spot that has some benefits.
Yeah, we're seeing a little bit of lift in the produce market, I would say. I've been studying the USDA data pretty closely. Volumes, as I mentioned during the show, it looks, I really feel like the Mexico import season has peaked, and so has the Florida one, which is really interesting. But California's coming back really strongly. those volumes are up about, compared to the same week last year, up about 50% on last year. But remember, year-over-year comps are not really useful in this respect, because last year they had all those atmospheric rivers really put a slow start on the season. Week-over-week gains were up about 10%. So it's all good signs. We're still getting a lot of produce come out of the Pacific Northwest. But overall, the market is sitting about 4 to 5% behind where it was last year. So, but we're just getting into the start of the Southeast produce season, which is kind of the bellwether for where the market's going to be at longer term. We're starting to see some decent volumes come out of Georgia and the Carolinas. The one data point that's sort of absent this year is there's an abundance of trucks for sweet potatoes out of North Carolina. When you follow their volumes are up about 27% year over year. The one thing that's fascinating with this is when you look at the USDA truck rate report every week, the one market that has a shortage of trucks nearly every week of the year is Eastern North Carolina, because of the sweet potato market. And I can't figure out why, but there's always a shortage of trucks. But for some reason this year, there isn't. There is an oversupply of trucks in that market. And I guess that fits the general pattern of produce volumes are a little bit behind last year, but we've still got a lot of excess capacity in the overall market.
I think that makes sense.
Yeah. We're starting to see a bit of movement in rates too, Ken. So I think people watching produce season, I think we're going to see some decent movement northbound out of Florida. Once we get into Mother's Day, the peak shipping season will cover in the next couple of weeks. But as we get to, I think it's the 12th of May is Mother's Day, when we look at the 2 weeks prior to that, that's when we see most of the shipping of carnations and roses start in the first week of May. In fact, when you look at total floral production for roses and carnations across the entire year, about 20% of the annual volume moves in the 2 weeks prior to Valentine's Day and Mother's Day. So they're pretty big shipping markets. Truckers don't like them. A lot of live load, live unload, hand unload. The boxes of flowers don't travel too well. So there's not a lot of love for those days when it comes to hauling those particular freights. But rates could be pretty good, according to Ratecast, on some of those lanes coming out of the Miami market in particular, where about 95% of roses and carnations arrive in Miami from South America. That'll be starting in the next week or so.
Something to look forward to,
yep.
Right?
Yep. Absolutely. All right. So
what are we missing? Anything this week? Plugs?
We've got Landline Now again, as always, on Sirius XM channel 146. I'm on with Jimmy Mack on Road Dog Radio on Thursday morning. Chris Kaplis is talking to Woody Richardson. This is a really good listen, talking about his recent book, Roads Rarely Travelled, avoiding the biggest mistakes in truckload purchasing. He's former exec at Schneider. Really good read. Next week, we've got Gary Cornelius from TWC Truckload and Drayage on the show. He's also a really good guest, great to speak to. Of course, Road Check Week's coming up around the corner, May 14 to 16. Make a diary note for that one. We expect to see some market disruption whenever they bring in a focus on brake checks and trailer connections. You'll generally see some problems and out-of-service issues. So that's all we have this weekend.
Can you give the dates for Road Check one more time, Dean? I think that's going to be an important date on our calendar, because whether you're an analyst or a truck driver, it's going to be really important this year. Yeah,
the Federal Highway have said May 14 to 16. But I would, if they say May 14 to 16, I would be thinking, because what they tend to do, May 14 to 16 is Tuesday to Thursday, that 72-hour period, they call it. The reality is they'll start on the weekend prior. Like it's a full on, and don't be surprised if they do something the week prior also. So you never know. I'd just be prepared. But the reality is anything to do with brakes and fitness for duty, drivers should always be prepared for that every single minute of the year.
That's right. And again, that's the time period last year where we start to see rates go up a little bit and stay there for the summer. So that's why I call to analysts to look at that.
Got a question from Dan.
Dan Deegan. We can't leave without Dan's question.
Thanks, Dan. Dan asked, with flat rates on the rise, what do you see this translating to overall freight demand? Overall, yeah, Dan, I'm not sure. I think we've got to, as I said on the show a couple of weeks ago, I think we've got to wait probably till the middle of May before we see if the flatbed rates in particular are going to continue on like they did in 2018 or start to taper off like they do in most years in the middle of May when it's a soft freight market. We're not at that inflection point yet, although there are some signs that flatbed demand is starting to cool off. So yeah, I don't know that I can answer that categorically right yet, Dan.
Okay. My plugs. So we've got a busy spring. We're going to be at Gartner. So that's going to be fun, mainly a shipper show. So we look to see you there. I will be debating FreightWaves' crew at their event in June, apparently. That should be fun. A lot of memes, a lot of Rocky references. I think that should be generally a pretty good time. I think the betting line opened on the number of mentions of Black Swan and Bloodbath. There were about 25 each. I'd take the over. Hot betting tip there. But that should be a fun time to get down there and actually participate in one of their events. Yeah. So whether we agree or disagree, I think it should be a meaningful discussion about looking at the market a couple different ways. So that should be fun. And then again, we were happy to connect with everyone at TIA. Anyone who has any follow-ups that are lingering, feel free to drop Dean or I a note on LinkedIn or through our Ask IQ inbox. Tons of great conversations. I was very proud of our team. They showed up in a big way with their learning labs and whatnot. So it was really fun to get down there. But with that, we're going to wrap up this week. We'll see everyone next week at 10 a.m. Eastern, and we hope everyone has a great week.
Yeah.
Bye, everyone.
Bye.